Hello all. Today I'm presenting a paper on syndication strategies co-authored with Mehra, in which we try to understand the investment performance through syndication practiced by foreign and domestic VC firms. There has been a rise in cross-country investment by venture capital firms, which is what we think makes this study so interesting. You must be wondering why VCs in India. Other than the fact that we had the data on India, India's startup ecosystem continues to be the third largest in the world, behind only US and China, with nearly 400 active institutional investors as per NASSCOM. We define an active institutional investor as one who has invested in at least one deal in 2019. And 2019, you witnessed the highest ever investment by VCs with over 10 billion US dollars in investments across more than 700 deals, according to Bain. Another interesting figure is that the addition to startups last year was huge, 1,300. And the total number of really huge startups that we call unicorns, startups with more than 1 billion US dollars, they increased to 24. Second question, of course, is why US VCs in India? And US, of course, continues to dominate not just the India market, but the VC market globally, contributing to over half of all cross-border investments during last year, again, as per KPMG. Let me talk a little bit about the research gap that we try to fill by pointing you to some of the previous studies. There are many cross-country studies in literature that examine VC firms investing across the border and whether they make successful exits from portfolio companies. And I have listed many of them. Chemanur, Hull and Krishnan from 2016 had a study that is the takeoff point for our study, where they study the impact of foreign and local VC syndicates on exit rates in 14 nations that include both emerging and developed countries. Our point is that syndication preferences of foreign VC firms are impacted by many things: cultural distance, institutional setups, and of course, country level uncertainty. Many of these have been pointed out in previous studies like Dai and Nahata in 2016. And so we feel that the aggregate findings by Chemanur might not hold at the country level. And we then proceed to examine this issue at a more granular level. If you take a look at these indicators given out in the World Governance Report 2018 by the World Bank, you can see that there is quite a lot of difference between VC fund receiving countries and VC fund investing countries. In this slide, I show an example of one of each country, the US and India. And you see that India, a major VC fund receiving country, for example, take the fifth indicator, the rule of law. That has a percentile rank of about 55, while the US, a major VC fund investing country, has a percentile rank of nearly 90. So clearly a wide difference. In this slide, I have taken the 14 countries used in the Chemanur study and see how they fare on two indicators of the worldwide governance indicators: regulatory quality, which is in the top panel, and the rule of law, which is in the bottom panel. And you can see there are clearly wide differences in the 14 countries. In fact, if you look at the Doing Business report, again issued by the World World Bank, 2017. The group of 14 nations that are included in Chemanur's study, and I don't mean to beat down on it, but just make a case for why our study is important. That study includes Malaysia, which is ranked 23, along with Nigeria, which is ranked 169. Therefore, the results reported in this study may be misleading, since this type of aggregation of vastly differing countries masks the very differences that we want to study and may lead to erroneous conclusions. Turning now to the literature on Indian VC, most of that literature has been focused on trends. Actually, most of the VC literature is really very Anglo-Saxon centric, but the research on developing countries and India in particular has been focused on just trends and evolution of VC in the country, and some survey papers studying VC practices in India. Joshi and Subramania, for example, in 2016 did do a study of strategies adopted by foreign VC firms in India, and was a stellar study. It was based on primary data collected on 72 VC firms that were active in India, and they concluded that foreign VC firms use syndication as a risk assessment strategy to overcome information strategy. So while they may be using that, there's no paper that looks into how this syndication impacts the bottom line, which is what we're concerned with, is the VC firm's actual performance. And that is where we come in. And what we find is that foreign VC firms have higher fund exit rates, and they are able to overcome the barriers through syndication. But funnily enough, syndication has no role in explaining fund exit rates for domestic VC firms. So they don't seem to benefit by syndication. And contrary to the Chemanur result that syndicates that include foreign VC firms and local VC firms perform better than those that are only foreign or only local, we find that in India, syndicates that take foreign VC firms only, they perform better than syndicates that have local VC firms only, or syndicates that have local VC firms and foreign VC firms, which is a totally new result, and comes out from, as I said, not lumping together many different types of countries. We take 6 different hypotheses in the paper, and or basically to understand different strategies that a syndication might take. I won't go through the individual strategies, time is short, but you can read them. Data, very quickly I want to point out, we take the data between 1995 and 2011 because before 1995 the SEBI Venture Capital Regulation Act did not exist, and it's only after that that VC investment started to grow really significantly, and we stopped at 2011 because we want several years of data to observe the outcome of this investment. And we only take those portfolio companies that Thomson 1 classifies as the investment stage as being venture capital and no other stage. And we have a very, very robust sample of nearly 3,000 investment deals in about 1,300 unique portfolio companies located in India by nearly 700 VC firms managed by 700 VC funds managed by 450 VC firms, which is a really, really good sample. If you look at this table, you can see some of the highlights that 46% of the deals are foreign VC financed, 44% of the deals are syndicated, and 33% of deals are early stage deals. So we take a good chunk of the VC investment. Success in the form of IPO and M&A is 21%. That is 1 in 5 deals are seen as successful. I will focus only on 2 sets of numbers in this table. One in the red that show that the hypothesis is supported that portfolio companies funded by at least one foreign firm have a better chance of success. Our H1 hypothesis, you see the coefficient is positive and significant in all the models. By the way, the models differ on whether or not they are control variables and whether the industry dummy is included. Thomson ONE database that we use classifies foreign portfolio companies in 6 industries. For regression at the portfolio company level, it's a simple dummy for each industry. And the second set of results that the numbers that I want to focus on are in green, that portfolio companies receiving funding from more than one VC firm perform better. You see the syndication dummy is positive and significant across all 6 models. I have just reported 3 of them. Also 2 other quick things. Our result indicates that when a portfolio company is financed by only one local VC firm without any syndication, its chance of issuing a public issue that is being successful or getting acquired, so either case leading to a successful exit, that is low compared to other portfolio companies. So that addresses our hypothesis too. And a portfolio company receiving funding from syndicates comprising of foreign VC firms only and no local VC firm is successful, our hypothesis H5. We do not find support to our hypotheses 3, 4, and 6. Quick discussion on our results. They suggest that foreign VC firms syndicating with local VC firms do not explain the chance of a portfolio company success. Our results suggest that a foreign VC firm is able to overcome the cultural, geographical, and institutional barriers while investing abroad by syndicating with other VC firms. And our results also support the findings by Cavell and Dietz of 2016, who reported that when the domestic network is thin, foreign VC firms tend to select co-investors from their industry-focused network among other foreign VC firms who are looking to invest in local ventures. So our results, most of them are consistent with previous related VC literature, and most signs are what we would think are expected. I want to just point out before I end, one major new finding of this paper is that syndication is not a determinant for VC fund performance backed by Indian VC firms. And that is, also has an explanation in the literature, which I won't go into right now. I thank you. That is the end of the presentation, but just want to mention that we are in the process of writing up the paper for submission, so any and all comments and suggestions would be very, very welcome. Thank you.